Hello friends, welcome to my channel The Risk Management Research. Today I am coming up with Fundamental of Risk Management Part 2. What I have done is I have broken down Fundamental of Risk Management videos into the three parts of a small videos so that it is easily digestible. In our first part we have seen that what the risk is, what is the definition of the risk management, and what are the challenges in understanding the risk. In this video we are coming up with benefits of risk management, what is enterprise risk management, and what is the difference between enterprise risk management and the silo risk management. In the third part we shall discuss the risk management framework, the COSO risk management framework, risk management process, risk appetite, and three lines of defense. Let's look at the risk management in the context of business. And uh, generally, in the modern days, risk management is mostly associated with the financial institutions like banking, insurance, mutual fund, wherever there's a financial transactions are going on. But that is not true, because risk is everywhere, and every organization has got certain vision. They have got they, they are in the business because they want to create certain value and a certain brand for themselves, and that is why they are in the existence. So therefore, whenever an organization has got their entity, so they have got a vision, something which is is a state where they want to reach, and then there is a mission. So in the context of the vision and the mission, there is the strategy is the high level plan to achieve one or more goals under the uncertain conditions. So every organization, whether it is the financial institution or it is not a financial institution, they have certain objectives to meet, because it is all about the futuristic thing that the company is existing. They have to achieve certain vision into the future, and they are creating a strategy to achieve those objectives, those visions. And therefore the risk exists for all the organizations, and all the organizations need to have risk management functions, and they should have risk the chief risk officer in order to manage the risk. So if we look at the risk, the uncertainty about the future, not achieving the vision and the mission, failure to execute the strategy. So what is the risk for any organization, irrespective of whether it is a financial institution or it is not a financial institution? It is the uncertainty. The future is always going to create the uncertainty. So what it can do, it can basically not, the organization not able to achieve the vision. We have seen, if we go back around year 2000, we had so many organizations, those were existing that time, and but now we don't see their names have been vanished. It's that there was an uncertainty, and the vision they wanted to achieve, they have not been able to achieve it. So it is not just the financial institution, but it is with all the organization, and it can happen with any of the three things. One, the mission, vision, or strategy. Strategic risk is something which many organization misses it out, because this is people generally misinterpret between the risk and the strategic risk. Maybe I can take up the session on the strategic risk separately. And the management of these these risk management is the mitigation action. So any organization who is existing has got a certain brand value. They have to have the risk management activities to to manage the risk, and that's how uh, the risk management exists in the context of the business, though risk management is basically more coming in recent years, particularly after so many crises, uh, 2008 economic crisis, COVID-19, and we have been seeing various other failures of banks and insurance companies in the different parts of the world. Let's move on. Now, when what are the benefits of the risk management? One of the benefits of the risk management is that when there is a action plan is there for the future, uh, how to handle the uncertainty of the future. One of the things that it do is that it reduce the earning volatility. What it means that earning volatility is there is a revenue source. Any all the organization is working for the revenue and the profit. So we have seen that because of the uncertainty of the business cycle, there is a uncertain flow of income and the revenue, and that results into the volatility in the profit. So once the risk is managed, it has been seen and observed that the organization has got a better flow of their the revenue. They can just balance it out. They can address what are the issues that what are the sales issues that need to be addressed, so that their revenue is smooth. Second is maximize shareholder value. Lots and lots of paper have been written on enterprise risk management and how does the enterprise risk management enhances the firm value. This has been proven by using the statistical models, taking the independent variables and the dependent variables, and it has been proven that enterprise risk management enhances the shareholder value. Different in different setups, like in bank and the insurance companies, the percentages are different. It may ranges from 5% to 20-25%. So there is a clear message that enterprise risk management or the risk management maximize the shareholders value. It reduces the surprises because risks are better managed, the future uncertainties are better planned, and as a result of that, there is a reduction in surprises in the future. That's the the another advantage. This is the another one of the beautiful things that is the better decision making. Once risks are better understood within the organization are able to take decision in such a way that that do not have kind of a volatile profit, because their decision is based on certain risks. They have considered the risk within the business decision, and as a result of that, the volatility within the profit or the losses are reduced, and therefore the better decision making helps. And another thing that comes within the better decision making is the defining of the risk appetite. Once organization define the risk appetite and that flows into the decision making process, then it really helps the organization in smoothening out their profits. uh, Maximize capital and profit utilization. um, Capital is basically the shareholders money, and this is particularly is very popular concepts in the bank and the insurance companies. And this has again been proven in many of the academic literatures that it maximizes the capital requirement. And that is one of the reasons why you might have heard about the concept of risk based capital. And this is one of the reasons there is a linkage of risk based capital and the enterprise risk management. So these are all linked terms. between um, between the the various benefits of the risk management. So next concept which it comes is the enterprise risk management. Why I'm bringing enterprise risk management? Because this is a very, I would say, recent terms means not very old, came out after the year 2000. Prior to that there used to be a silo risk management, which we shall talk about in the next slide. What the enterprise risk management is, that enterprise risk management is applied across the organization, from board to the last employee. So in the enterprise risk management is applied across the organization. So it is not that few few departments are doing the risk management activity. Like generally it is believed that in any organization risk management is being performed by the risk management function. No, this is an absolutely a wrong concept. If in any organization risk management is being done by only by the risk management function, then they are not doing enterprise risk management, they are doing silo risk management. In the enterprise risk management, every employee is to do a risk management activity, and that's why this enterprise risk management concept has come. And we shall see under the risk management framework that what it means, that what are the framework concept within the enterprise risk management. On the other hand, silo risk management is applied by the few departments. So the earlier concept was, because risk management is existing ever since the mankind, whether it is the bank or the insurance companies. I would give the example, both are running, both works on the concept of a risk. So the risk management was there ever since these two organizations have been in existence, but they were doing silo risk management, because the risk like uh, credit risk, liquidity risk, or insurance risk, they were managed by the independent departments. Say for example, it was managed by the underwriting team. Let's say in the insurance company, for a mortality risk, it was managed by the underwriting team and the claims department. So it used to be end over there. If it is the interest rate risk, it used to be between the treasury team and the actuarial team, and it ends there. If it is a liquidity risk, few people sitting within the bank and the insurance company are doing the liquidity risk, and it ends there. That's not the enterprise risk management. And there is a heavy cost of having the silo risk management concept, and therefore it has been seen that the silo risk management does not work to its optimum utilization. What happens that many of the risks within the organizations are correlated. There is a correlation between one and the two risks, and when we are doing the silo risk management activities, then they cannot be addressed together, and as a result of that there is a loss of, in terms of there is a doubling of the human effort, and the risks are not properly captured. Because of course the if we look at the example of the credit risk and the liquidity risk, definitely both are linked, and they may have a linkage in terms of that if the credit risk increases, that has got an impact on the liquidity risk. If both are working in silos, then the people doing the liquidity risk activity, they may not understand what is the issue in the credit risk, and therefore uh, the togetherness is important to manage under the enterprise risk management. It, as a result of that, the silo risk management is expensive and difficult to manage. It not only require more resources, but difficult to manage because of the correlation of the risk. And also there is a governance aspect also. That governance aspect which is being captured under the enterprise risk management is not captured under the silo risk management, and that is one of the biggest change from the silo risk management to the enterprise risk management. Now let's look, some of the differences between the enterprise risk management and the silo risk management. So enterprise risk management is integrated company wide. So as I said in my previous slide that it is company wide. Silo risk management is also called the traditional risk management, and in short, TRM, and that's what the differentiation I am creating. So traditional risk management is structured risk management that addresses risk independently. So whether it is a liquidity risk or it is a credit risk or it is an interest rate risk, they are addressed independently. Here in the enterprise risk management, it is addressed together. Correlated risks are allowed to benefit from the risk management and diversification of the risk. As you know that under the Basel norm and also under the risk-based capital under the solvency in the insurance sector, risk-based capital is calculated in terms of the monetary amount, and there is a diversification effect is allowed. So it is basically the correlation of the risk that allows the diversification of the effect, and it reduces the overall capital requirement by the amount of the correlation it has got. Right. So that is the example of the correlation of the risk, whereas in terms of silo risk management, no comprehensive interdependencies or integration of risks of the portfolio are present. That's the second difference. Enterprise risk management takes the firm's risk appetite into the account. Why it takes risk appetite into the account? Because it is being done at a company wide level. Therefore the risk appetite could be at a risk level, at a aggregate level, and once we are dealing with, there is a leeway to define the risk appetite. TRM is technical and not strategic in nature. The CEO, CRO, and the board are the responsible for the enterprise risk management development and implementation. Because as I said that there is an element of the corporate governance as well within the enterprise risk management. Independent departments manage the risk. That of course, corporate governance are there within the organization, but it is not integrated into the risk management when it deals with the silo risk management, and when it comes to enterprise risk management, the corporate governance is integrated. ERM plays an important role in the decision making. This point was captured in the previous slide as well. TRM is not used in the decision making by the company. It is because risks are managed and then it is finished. Where applicable, assign capital to attain the maximum risk adjusted return. It does not consider the allocation of the capital. This is true. Focus on both downside and the upside. ERM is the value addition. Yes, that's true, because here it's both, the opportunities are also encashed, whereas in the silo risk management only the downside of the risk is managed. Risk owners are assigned with the accountability. In the enterprise risk management, what happens that the different function heads are the owners of the different risks. This does not happen under the silo risk management. ERM uses a holistic risk oversight framework and risk culture to address several types of the risk. TRM concentrates only on the quantifiable risks, for instance market risk, credit risk, etc. So these are some of the fundamental differences between the two, and silo risk management has become the thing of a past now, but it's important that what is the difference, so that we understand that we are not doing a silo risk management anymore. In part 3 we shall discuss risk management framework, COSO risk management framework, risk management process, risk appetite, and 3 lines of defense. We shall continue in our part 3, and see you till then. Bye bye.